Hey, well, I'm here. Took a little longer to log in today, but we're finally online. Um, so office hours are wide open. Here we go. Had a couple questions, mainly on material from chapter two, which was accounting, what level of detail we should get into, etc. Um, how important are the ratios, etc. So that stuff, we can talk a little about that. Didn't have an awful lot of questions. Let me check one more time here, the different email account, but as of a few minutes ago, I didn't have many questions. Um, so what I was thinking of doing instead was to talk a little about an overview, just do a quick review of chapters 2 to 4. Yeah, no, I don't have any more, again, questions. So let me quickly see the ones I do have here. Um, so questions that did come in, idea of Nexus of Contracts, that is something we need to know for 301, absolutely. We'll talk about explanation. And Chapter 2 quiz is due on Monday. That is also correct. Um, so Nexus of Contracts, and then we'll get into a review. So if we look at, and I've too many windows open, I can't find myself again. Okay, so here we go. If you think of the Nexus of Contracts, you have shareholders, you have managers, you have employees, etc. All the different stakeholders. You have bondholders, you have customers, you have long-term investors, etc. And there's contracts between all of them. So we have Nexus is just another term. Think of interconnectivity or interconnections across lots of different stakeholders. What we're concerned about in finance is making sure that there's not a lot of fighting between the different stakeholders. For instance, bondholders and shareholders disagree on risk. Shareholders like risk more than bondholders do. So we might structure our contract, our bond contract, in a way that they're not going to fight so much. So, for example, it might put callable debt in, puttable debt, convertible debt, things like that. We put restrictions, we put covenants in place that say you cannot take enormous risks, or you cannot pay liquidating dividends, or etc. So, very important concept. Nexus of Contracts is very big. All of the different stakeholders will have slightly different incentives, slightly different wants, desires, needs, etc. And one of the big things, the art part of finance, is making sure that we understand that and try to get everyone on the same page to increase the value of the firm. In the ethics section, which we talked about, I guess it's been 3 weeks ago now, we talked about the importance of each of them, looking out for each of them, because it has to be win-win. In the long run, the employees have to be happy to make the shareholders happy. The customers have to be happy or they won't keep coming, and then therefore the shareholders are unhappy. So in the long run, maximizing shareholder value, which is our ultimate goal, is going to maximize the value of all of these. Reputational capital is very, very important to shareholders. The market is an amazingly harsh or strict disciplinarian. And if we start cheating, lying, stealing, acting fraudulent, customers aren't going to want to buy from us, employees aren't going to want to work for us, people aren't going to want to enter long-term contracts with us. Now, they will do it. It's still, they will work for us, etc., but they're going to demand a higher premium, and that impacts the bottom line. So whenever there's information efficiency, everyone knows what's going on, we all tend to act better. So I'm a big fan of transparency in everything, and especially when it comes to the Nexus of Contracts. So I hope that answered your question. After we did the Nexus of Contracts, we talked a little about behavior, REM behavior. People are resourceful, they're evaluative, they're maximizers. And I think that's another topic that you definitely want to remember when we're talking about stakeholders. Stakeholder theory is pretty interesting. I just had a question come in. How clearly defined are the risks in the contracts? What would be some examples? Risks in contracts depending. Some contracts are explicit, some contracts are implicit. I think the example we used in class, if you buy a thing of water, you have an implicit contract that the water is safe to drink. You never signed a contract saying it is safe to drink, but you assume it is safe to drink. That's an implicit contract. Other contracts, for example in bonds, are usually very, very well defined. I'm pretty sure that was an extra credit assignment. think for 301, I know for 401, if anyone's watching from 401, to go through a bond contract and actually label, what are the covenants, what are their purposes, what are they trying to do there. So a lot of risks are not perfectly defined in finance because we don't know. We talked about that the other day with tail risk, where the black swan events happen, and you can't label every single thing. All you can do is take as many precautions as possible, and that's true for any industry, for finance or for whether you're a production operations manager. Something could happen, the roof could cave in, etc. You can't always prevent them, but you do everything that you can in an economically justifiable way. And we will talk later in the year about risk management, and I think the key idea out of that is going to be it's risk management, it's not risk minimization. Taking risks is part of life, as part of business, it's part of everything. Bond responds, you see in the background here. Bond responds, we take risks, but we do try to at least mitigate them some. Hopefully we aren't taking stupid risks. The same thing in business. Investing all in one stock is a stupid risk. You're taking on a lot of risk that you don't need to, that is diversifiable, that we could get rid of, and we don't. So I think that's a good starting point when we go through the whole year. I mean, understanding that you do have to take risks, business takes risks. Within the model of the financial system, the next area we talked about was from the corporation's perspective, how can they convince investors to buy shares? And my lights just went off. But how can they convince investors to buy shares or buy bonds? And the way they do that is letting people see, increasing transparency of what's going on at the firm. That is accounting. That was all of Chapter 3. Chapter 3 was devoted entirely to a review of accounting. Make sure. And within Chapter 3, they talked about all the big ones, and we talked about them in class. We talked about balance sheets. We talked about income statements. We talked about cash flow statements and statements of stockholder equity. If there is one section, I mean, the whole chapter, clearly read it. You should know it, but make sure especially you know cash flows. Statement of cash flows is section 3.4, and then also the pages 75 to 77 on free cash flow. We're going to use it an awful lot. We're going to, later in the year, we're going to talk about free cash flow and valuation. Really, probably the most important thing in chapters 2 and 3 is section 3.7. Very, very important. So look at free cash flow. Free cash flow is cash that's left over after you've done all the things you need to do. You've reinvested, you've bought new supplies, new tools, paid your employees, everything else. You have this pile left over. What do you do with it? You could give it back to investors. You could do something else. A big problem we talked about briefly is that if you have too much cash, sometimes you waste it and you invest in things that you really shouldn't be doing. So that's called Jensen's free cash flow problem, and we'll talk more about that's called an agency cost. We'll talk more about that probably next week, but just keep that in mind as we're going through it. Chapter 4, which is the next one that you are responsible for, that was ratio analysis. The name of the chapter is Analysis of Financial Statements, but it is basically ratio analysis. Ratios are quick ways of looking at lots of data very, very quickly. No single ratio catches everything, so there's lots of them trying to depend on what you're looking for. If you're looking at how well a company is doing, you want to look at management ratios. And how well management is doing, you want to look at management ratios. If you want to see how much debt they have, how much leverage ratios, how much risk they have, you want to look at capital structure or leverage ratios, long-term debt ratios, times interest earned, etc. Market value ratios are often used to value firms. The key ones there, PE ratio, enterprise to EBITDA ratios, market to book or price to book, depending on who you're listening to, ratios. And there's there are a lot of them. I understand that. There's table 4.2 lists quite a few. I list more on the website. There's, everyone has their own favorite ratio or favorite set of ratios. I will warn you over and over again, ratios are only useful in context. They're, in isolation, they mean nothing. The example we used in class is 55 miles an hour. Is that fast or slow? And it depends. It depends on what you're driving. It depends where you're driving. 55 miles an hour on the Indianapolis 500 is really slow, but 55 miles going across, I don't know, the library parking lot is really, really fast. So it depends what you're driving, where you're driving. In finance speak, what we're looking at either time series wise, so how did you do last year, how did you do the year before versus this year, or cross-sectionally. How do our ratios compare to others in the industry? So we can either compare them with ourselves across time series, or ourselves versus others in the industry cross-sectionally. So remember that it's pretty important. When we're valuing firms, we do it both ways. We do it time series. So the PE ratio for a company has historically been 15. It's currently 12. That would suggest we're underpriced if everything is the same. If we also look across the industry, everyone else in the industry has a PE ratio of 15, ours is 8. Well, it's seemingly one number, seemingly we're undervalued. But you want to look at all of these ratios. You never look at one in isolation. They're all going to sort of surround it. It's like one, if you want to think medicine, it's one symptom. You know, you have a headache. Well, it could be a million things. You have a high PE ratio. It could be a million things. And then you start looking for more and more, and you try to bring them all together to see what is the prognosis for the firm. Is it good? Is it bad? Etc. So very similar to looking at different indicators. Ratios are very widely used. Speaking to teachers at other schools, I think this is one of the biggest things for all of 301 to get. I'm not convinced of that because they're pretty easy once you get them, and you can look at computers and printouts. It's all very cookbook at that point. So I think that and time value of money, so chapters 4 and chapter 5, are pretty much the standard foundation for introductory finance classes. So we will spend all of next week talking on chapters 4 and chapter 5. That'll be next week's classes, and that's going to be after that. After chapter 5, you should be able to do your first project on personal finance investment, personal finance, your forecast of how your life will be financially. So make sure you spend a lot of time on chapter 5. Read chapter 5 for this coming week. So I think that's pretty much all I wanted to talk about. A couple sections of the book that I thought was particularly good. Financial analysis on the internet, page 101, matches up very well with the video I posted on Moodle. I think I also emailed you, I think. It's in the notes as well. Also, the free cash flow analysis and warnings, the warning on limitations of ratios is also good, and that's on page 121. Uses and limitations, section 410, is also one you should pay a lot of attention to. The DuPont identity, or the DuPont equation, is on section 4.7, was the very last thing we did on Monday. So it is there that, you know, the ROE and equals profit margin times total asset turnover times the equity multiplier. I think, you know, it might make sense to talk a little about that for a second, just even though I didn't have any questions on it. I think it's an important area because what we're looking at here is, you could argue very well that ROE is the most important ratio. If shareholders are the most important group, this is essentially saying what do they get for their investment. And there's 3 ways to, I don't know if you can read this, so put it up, maybe you can. Not so much. Well, a little. There's 3 ways to make money. You either turn your assets over, so you make a little and you turn it over a lot. So profit margin is one indicator, or turnover is the other, or leverage is the third. So you magnify leverage ratios. Leverage is just a magnifier. In the saying I always use in class, and I hope you guys remember, debt makes good times great and bad times horrible. If you have a little debt, you're okay. If you have a lot of debt, as soon as something bad happens, it's just going to be miserable. Those debt payments have to happen whether or not you're making money, and it causes a lot of problems for firms and for individuals. So so that's pretty much it for chapters 3 and 4. If anyone does have any questions, holler away. I guess I forgot to. I'll open up more for questions. But if you do, I'll be on for a few more minutes at least. I am very happy with the how people are doing. on the quiz, the first quiz. Average so far is a staggering 88, almost 89%, and 2/3 of the people have turned them in, so that's good. We still have 6 people who have not registered for it online, so that's somewhat of a problem. Should probably make sure we do that sooner rather than later. This make sure. No, I thought I had another question coming. This week, the Friday forum is on energy. I am doing it, so I understand you may or may not want to come just because I'm talking, but I think it's going to be really good. I'm super excited about it. I've been begging the SIM students probably since June or at least July, and many other people I've been talking about. I took just a phenomenal class. I loved it on energy. And so what we're doing is talking about the energy markets this week. And given that we have an energy hedge fund, given that we have an energy sector that we follow very closely in SIM, and given the size of the energy market is enormous. Think of everything. Energy is the #1 correlated item with the economy. Countries that do well have a lot of energy. Countries that don't, like Haiti, have very little energy. So we're going to be talking about that. We're also going to be talking about it in the context of global warming. We're going to talk about future of energy, looking at renewables from solar to biogas and biodiesel and pretty much everything else, from nuclear to wind, etc. So I think it's going to be a pretty good. I'm concerned about squeezing it all into a 55-minute or 50-minute section, but I do think it'll be fun and interesting. And if we don't get it all, we don't get it all. We'll come back and do another one in the spring or later in this semester even. So, all right. Well, I guess I don't have any other questions. Thanks. I thought the class went really well this week. I was happy with everyone. I thought everyone answered questions pretty well. I did like the idea that we got a little further in depth on options than I was planning, but that's good. So, and I think that's about all. So I will be talking to you guys soon. See you hopefully Friday, and if not, definitely Monday. I will also follow up with an email for students. I have a couple links that I want to show you for next week. So thanks, everyone. Bye.